Nestlé just announced it's cutting 16,000 jobs, and the market's reaction? An 8% surge in its share price. It sounds heartless, even cruel. But here's the question that should stop you in your tracks. Why do investors celebrate layoffs? Because in the strange logic of modern capitalism, pain on the ground can mean profit in the clouds. And Nestlé's story today isn't just about jobs. It's about power, perception, and the brutal efficiency of the markets. By the end of this video, you'll understand why massive layoffs can make a company's stock price explode, how Wall Street interprets efficiency differently from ordinary people, the psychological and financial game that drives these reactions, and what Nestlé's $10 billion turnaround plan really means for the future of the global consumer goods industry. Stay with me, because what looks like a tragedy on the surface might just be a masterclass in how investors think. Nestlé, a name we associate with chocolate, coffee, and childhood memories, is also a $300 billion behemoth. It operates in nearly every country on Earth, selling over 2,000 brands, from Nescafé to Kit Kat to Purina. But behind that comforting image lies a relentless pursuit of margins, efficiency, and shareholder value. In recent years, Nestlé has faced mounting pressures: slower global demand in developed markets, rising input costs from inflation, and growing competition from smaller, agile brands that are stealing consumer attention. Its profit margins were thinning, investors were losing patience, and in the high-stakes world of corporate strategy, when earnings lag, someone has to pay the price. Enter the restructuring plan. A sweeping internal overhaul designed to streamline operations, corporate code for cutting costs, trimming layers, and yes, eliminating jobs. Here's the brutal irony. For employees, layoffs are devastating. For shareholders, they're often a reason to celebrate. This isn't unique to Nestlé. It's a pattern that repeats across corporate history. When a company announces job cuts, the market often reads it as a sign of discipline, that management is serious about protecting profitability. Let's dig into the psychology of investors for a moment. Investors don't see 16,000 jobs lost. They see $1 billion saved. They don't think about families or livelihoods. They think about EBITDA margins and return on capital employed. That's not necessarily cruel. It's how markets are programmed to think. In the investor's eyes, labor is a cost. And when costs fall, earnings rise. When earnings rise, valuations improve. When valuations improve, the stock pops. That's why the market reacted instantly to Nestlé's announcement. An 8% bump in share price translates to billions in market capitalization. Wall Street's logic is cold but consistent. Still, it raises a deeper ethical and philosophical question. Can a company truly thrive if its success depends on cutting people loose? Nestlé's CEO framed it as a transformation toward efficiency and focus. Analysts called it a bold step toward higher margins, but workers called it something else: betrayal. Here's where things get interesting. Layoffs are rarely just about reducing payroll. They're about signaling. In corporate finance, every move a CEO makes sends a signal, not just to employees, but to the market. When Nestlé announced its 16,000 job cuts, it wasn't just trimming fat. It was broadcasting a message. We're serious about change. It's a form of performance art for investors, a declaration of intent that says, we're optimizing, we're modernizing, we're maximizing shareholder value. And the data backs it up. According to decades of market research, companies that announce cost-cutting measures often see short-term boosts in stock prices, even if the long-term operational benefits are unclear. But here's the twist. While investors cheer, companies risk losing something money can't buy: culture, trust, and morale. A demoralized workforce can sabotage productivity in the long run. So while Nestlé's short-term gain looks great on paper, The real test will come over the next 24 months. Will the savings translate to sustainable growth, or will it hollow out the company from within? That's the fine line every global CEO walks, between financial logic and human cost. To understand Nestlé's move, we need to look at history. IBM, General Electric, Unilever. Each has gone through similar waves of restructuring. When IBM laid off thousands in the early 1990s, its share price rebounded. But morale collapsed, and innovation slowed. When GE slimmed down its divisions, investors initially cheered, until they realized the company had cut too deep. And when Unilever launched its zero-based budgeting campaign, trimming jobs and overhead, its profits surged, but employee satisfaction plummeted. So, where does Nestlé fit into this pattern? Unlike those earlier examples, Nestlé is pivoting amid an AI-driven transformation of supply chains and marketing. The company's plan includes automation, digital analytics, and decentralized decision-making, meaning many of the lost jobs are being replaced by algorithms and machines. This isn't just cost-cutting, it's evolution. Nestlé is betting on efficiency through technology, betting that it can produce more with fewer people. In the eyes of investors, that's smart business. In the eyes of society, it's a moral gray zone. Here's a question worth asking. When every major company is automating to stay competitive, what happens to the global workforce? So what can you learn from all this? Whether you're an investor, entrepreneur, or employee. 1. Understand market psychology. Investors don't respond to headlines. They respond to perceived efficiency. Learn to read the subtext of corporate announcements. 2. Follow capital allocation. When a company like Nestlé restructures, follow where the money flows next. R&D spending, AI infrastructure, dividend payouts, that's where the real story lies. 3. Balance human and financial capital. If you're running a business, remember, short-term cost savings can destroy long-term innovation. Efficiency without empathy is fragile. 4. Invest with awareness. Look beyond the share price reaction. Study how strategic shifts impact long-term brand equity. 5. Prepare for the automation era. The future belongs to those who can work with technology, not fear it. Here's the paradox of our time. A company can lose 16,000 people and gain 10 billion in value overnight. It's easy to point fingers, to say corporate greed, but the truth is more complex. Markets reward what they can measure, and empathy doesn't fit neatly on a balance sheet. Yet here's the hopeful part. Every layoff, every disruption, every technological shift also opens doors for reinvention. For employees, it's a wake-up call to reskill, reimagine, and reclaim agency. For investors, it's a reminder that behind every profit margin, there are people. And for all of us, it's a lesson in perspective. That success isn't just about efficiency, but about endurance. Nestlé's story is still being written. But one thing's clear. In the economy of the future, understanding both the numbers and the narrative isn't optional. It's essential. So stay curious, stay strategic, and as always, think wealth.